The secret sauce behind the application is yield account. Yield is better than interest. We generate yield. We don't generate interest. We aggregate liquidity from little guys, from retail people. We feed that liquidity to the DeFi markets, to different pools providing liquidity. And we're getting paid for that based on the activity that happens on those pools. So in the lame terms, you can deposit your crypto, you can deposit your fiat, right now USD dollar, and can start earning on that. Daily interest, compounding, no limits, no minimums, no holdbacks, no obligations.
My next guest is Maxim Galash. He is the CEO of CoinChange Financial Inc. Maxim, welcome.
Thanks for having me. It's a pleasure.
You bet. Okay, Maxim. So CoinChange Financials describes itself as next-gen crypto and DeFi investment platform. Can you explain exactly what the business is and the opportunity is for investors?
Yeah, let's start with the mission here. Okay, so we started building the product about 3 years back, and today I think we have one of the most sophisticated DeFi yield aggregation platforms on the market. We try to bring Wall Street to the Mainstreet, right? We try to make a little guy earn some extra dollars on his hard-earned cash. All right, so the system has two accounts. It's a fintech application. You can register it on your phone. It's very easy to onboard. You take a selfie and a picture of your ID, and you become a coin changer, a changer, right? So you change your life in a moment of just downloading an application. So there's one account that's a brokerage account. You can buy and sell different cryptos, right, using your fiat. Right now, it's only the USD account. But the secret sauce behind the application is yield account. So what we say is yield is better than interest. Okay, so there's interest accounts on the platform like Nexo, BlockFi, Celsius. We generate yield. We don't generate interest. So it's a variable yield day per day. What happens is we aggregate liquidity from little guys, from retail people. We feed that liquidity to the DeFi markets, to different pools providing liquidity. And we're getting paid for that based on the activity that happens on those pools. So in the lame terms, you can deposit your crypto, you can deposit your fiat, right now USD dollar, and can start earning on that. Daily interest, compounding, no limits, no minimums, no holdbacks, no obligations.
Okay, how is the yield generated in the first place that you aggregate and distribute to participants?
So it's a great question. I would say no yield comes without the risk in the first place, right? So there's always a risk side and there's always a yield side. So our yield is risk adjusted, right? So today in DeFi, there's so many opportunities that can give you 200% but today, but minus 500 tomorrow, okay? Or zero tomorrow. We curate the earning opportunity on DeFi, right? So we have a research department, we have a risk team. We do a certain analysis to make sure that we participate only in the best pools and use only the best tools that DeFi has. You can look at us as a professional money managers in DeFi, right? If you don't want to explore it yourself, read about it, do all those analysis, have your own keys, you trust us as a CeFi DeFi platform. But the basis of generating the yield is providing liquidity to different pools. So if we go back into how pools operate and what is a DeFi overall, right? Everybody speaks about Web3, DeFi. What is that? So DeFi, decentralized applications, is an application that is built on top of the blockchain. So blockchain as Ethereum gives you a certain framework to design and develop different applications. So as an example, Uniswap is a decentralized application built on top of the Ethereum. What does Uniswap do, right? So what it does, it controls a certain activity and it enables peer-to-peer transactions. So today in DeFi, you can find exchange transactions, lending transactions, insurance, and a lot of other use cases. So Uniswap as a decentralized application has no bank account, okay? And it facilitates this activity called swapping. So you come with token A, you swap it for token B, and Uniswap takes a fee, right? So to swap it, when you come to take it, somebody needs to give it to you, okay? So we come into those pools like Uniswap, and we provide those tokens, but we provide them in pairs to those different pools. And when client comes, they do the swap, Uniswap charges the fee and pays part of the fee to us. So you can look at this business model as participation in the revenue of those decentralized applications. So we provide liquidity to about 17 protocols today across 4 blockchains, right? And we have a certain smart yield platform that finds, taking into the account costs, it finds the best ROI for the liquidity paid out. So the premise and basis of yield is providing that aggregated liquidity using economy of scale, getting paid for that liquidity through those decentralized applications that charges fees to the customers, right? And paying part of those fees back to the liquidity providers. But that's a very basic explanation. There is a bit of a more complexity that we can probably come to in the future conversation, because we do a bit of a boosting to that APY. That's why our yield is the highest on the market today, with the lowest risk.
Okay, so then in the context of classifying the risk category, would this be categorized as a high risk speculative investment, or would this be considered in the same context as a yield product from, say, Manulife Insurance?
I think it's a longer conversation, James, about the current financial markets and the risk associated with that, right? Really hard to kind of correlate, but I would say that, if you look from the traditional lens, any crypto investment is a high speculative investment. No matter what you do yield, you do trading, you're just buying and holding an asset. Crypto is a high risk investment, right? As it's seen today from the regulatory perspective and the traditional markets perspective. What we see as a market participant, and as we only operate in DeFi. We don't really operate in CeFi world. So we don't trade, we don't do arbitrage. There is mathematically zero market risk in our strategy. Okay, and it's not a one strategy. So when we go back to those pools, we operate across, 45 pools on 17 protocols. So what it means, right? So it means that our liquidity is spread out across multiple protocols, right? And risk is diversified. It's the same saying that you'll allocate your portfolio, let's say, to 40 equity markets or 1, right? So buying the composite. We're pretty much like a composite index, right, for the DeFi, right? Generating yield, but you not really own index. You still paid in kind of your asset. So if you put in the platform, if you deposit $10,000 tomorrow, James, into the high yield account, you're going to get daily compounding USDC on your wallet. Right? No, but under the hood, we use 5 assets, 5 stablecoins: DAI, BNB, USDT, USDC, right? And we swap between those pools, those assets. So it's not an arbitrage, it's not a trading. Our algorithm knows when AB is paying less than BC, and then it swaps the token, moves it to the other pool, right? Because the activity is higher in this pool. Let's say there's more trading happening, people are buying more, okay, and they're paying more fees. So then when we provide that liquidity, we get paid those fees. So the risk here is not the market risk. You're not exposed to market risk. And you're exposed to counterparty risk, but it's manageable. The highest risk in here is a technology risk. So when the pool is going to get attacked and drained, or there's going to be pool drainage for a purpose, right? So meaning somebody creates a pool, because anybody can create a pool. You can go tomorrow and create a pool on Uniswap, right? And start attracting customers, right? And liquidity providers like us. But we do certain risk mitigation. So what our risk department does is the basis, right, of the risk mitigation. They look at the pool and they say, okay, how old is the pool? It's been around for 5 years, 2 years, let's say, right? What's the TVL in this pool? Like $100 million? Okay, we can work with that. So our minimum threshold is a $100 million pool. Right? So there's already a liquidity in that pool. Who provides that liquidity? The other question, right? So we start looking who are other liquidity providers in the pool. So when we go through all the criteria by our defined framework and we think the pool is good, right? We go down. It starts with the blockchain, but blockchain, we can't really mitigate that risk, right? Ethereum is Ethereum. We have no influence on that. So then we'll look at the protocols like Uniswap, PancakeSwap, SushiSwap, right? And the others, Aave. We'll look, okay, because there's a lot of protocols. Every day there's new decentralized application, and decentralized application is a protocol. Okay, so they always come to market every day. So we do evaluation of that protocol. Is it safe? Who is behind it? Is there an audit? Blah, blah, blah. There's a full framework behind it. Then when the protocol level risk is analyzed, we go into the pools. because inside of the protocol, there's a lot of different pools. And pools meaning pools are always paired. Like think about them as a currency pair, like Canadian dollar, US dollar, right? Canadian dollar and British pound, right? So think about them, different pools, different currency pairs. We analyze those pools, we see who provide liquidity to those pools, okay? What kind of assets are in this pool? So is Canadian dollar and USD dollar a good pool to be, good pair to be in? So afterwards, when we pre-select those pools, we can select as well how much of our liquidity is gonna go to that specific protocol and into that specific blockchain. Because we're across 4 blockchains, we can say not more than 10% of liquidity goes to Binance blockchain as an input to our orchestration strategy. Then we can say no more than 20 goes to Ethereum, right? And inside of that blockchain, we can also set up limits, right? Saying not more than 50% of our liquidity, let's say, goes to Aave on Ethereum. Not more than 10 goes to Uniswap. And then the orchestration itself plays within those parameters that are set up. Parameters meaning protocols we chose, pools we've chosen, assets we've chosen, and the limits on liquidity that can be rebalanced. And then everything else is done automatically. So orchestration will decide, okay, today we're getting paid best for our liquidity on PancakeSwap for AB token. Moves it there. Real-time data analysis tells you, okay, right now we're paid better at BC pool, BC token pool in Uniswap. So we'll move it from Binance to Ethereum automatically through the bridges, through some other mechanics, and we're paid there. So all those analysis, real-time cost analysis, prediction on where the based on historical, this going to be a better ROI, that's all done automatically. So it's not me or anybody in the team sitting together and using MetaMask moving the liquidity. The beauty of that, it's really hard to replicate on the manual level.
Sure. So then this real-time analytics and sort of jumping in and out of these different pools and trades, this is an AI layer that's happening, that's running on a computer and is plugged into all these markets and is communicating directly with these different sort of exchanges and pools because it has access and has been granted access and is a trusted participant. I'm just trying to imagine, like, how do you make so many decisions in a single day? Is it all automated?
So, James, it's not an HFT. So there's no high frequency trading, right? It's a digital asset management, and it's a pretty slow business.
Oh, okay.
Right? We don't want to move around too quick. There's too many costs associated with that. Swapping costs, slippage costs, transaction costs, right? So what happens, like, I don't know, we can look at the historical, but probably a couple of times a day, the liquidity is moved around. It's already distributed across multiple different pools, right? So then it just rebalanced a few times a day, right? And there is no trading. We don't do any trading with the assets of our customers. It's all based on the liquidity provisioning, right, that I just explained with those pools, and those pools charge transactions to the customers, and we're not a customer, we're just providing the liquidity. And we get part of those fees. So it's like a revenue participation pretty much.
I see.
So the question a lot of your viewers would ask, I mean, how come you guys are paying higher yields than any specific pool, right? What do you guys do? Why your yields are higher than, let's say, some of the protocols you participate in? Like Uniswap is not paying 70% of the stable coins, but you do, right? So because of the aggregation, let's say Terra would pay 22% on your liquidity, right? Uniswap will pay 15, Pancake will pay 16. We average out, but our lowest yield is the highest yield we can find across those protocols. Okay, that's number one. Number two, when we take an LP token, that's where the magic happens. When we take the LP token, providing the liquidity, they give you something in return, right? That token, you either just hold it and wait, or you can lend it, or you can stake it, right? So it's a second level of boosting, we call it. So when we get the LP token from, let's say, PancakeSwap, because we provide some liquidity, AB liquidity to the pool there, we get this token, we can automatically put it in Aave and lend it out, okay? And then on a daily basis, because it's all compounded daily, everything goes back into your in-kind asset, into your USDC stablecoin, right? So that repeats itself, the cycle repeats itself every day. So it's a compounded daily yield, right? Higher than anything average you can find on the protocols, because there's a second layer of boosting.
Okay, well, it is a fascinating business, Maxim. I can't presume to understand it. but we're going to come back to you on another interview because this is really intriguing to me. Are you in a position where you would be raising capital to take your company to a higher level from investors?
Yeah, that's a great question. I mean, we're finalizing the round right now. So the closing date is February 14th. There's participation from 2 venture funds from London, UK. There's a participation from one of the funds in the US. And it's more of the venture money and strategic investment money. So we're talking to one of the exchanges as well, to their venture arm to put the money in this round. It's a $5 million round. So it's a small round, pretty much 5 million US. So 7 million Canadian. So yeah, we did a small round last year, about 2 million as well, right? So, and before that, the company was self-funded. Pretty much, I would say we'll announce the full participation of different investors on the 15th of February, because the official closing date right now is 14th.
Okay, great. Well, we'll have you back soon, Maxim, because I want to keep following this story and see how it evolves. Thanks so much for your time today.
Thanks, I appreciate it.
You bet. Bye for now.